Right. Well, good morning, everyone. Thank you for joining our second quarter market sense. We'll call this the spring edition 2026. I appreciate everyone taking the time to jump on this morning, and I certainly hope it's a good use of the next 45 minutes or so of your quarter. As I always do with these, we've got everyone in a listen only mode, just to cut down on background noise. So if you do have any questions or comments, please feel free to email those to me after the session, or follow up with your advisor. We're always happy to answer any questions that you might have. Um, but as we always do, I'm going to get started here with um, our speedometers from our friends at City National Rockdale, CNR, and their forward-looking economic indicators here. And what you're going to notice, and this is going to sort of be a recurring theme here today of sort of a mixed bag. And my overall theme is really around inflation and the impact inflation has, not only day to day, but as you broaden out and look at its impact in retirement. And we're going to spend a lot of time on that. I shouldn't say a lot, maybe 10 or 15 minutes on that towards the end of the session here today. But from an economic standpoint, a lot of what we're seeing is sort of kind of mixed messages, and a bit of a weakening economy. And I do not mean by any stretch a weak economy. We do not have, I would say, weakness, but we do have weakening. So some of the data that we've seen over the last couple of years that has been so very strong relative to our economy has weakened over the last couple quarters. And so you're getting a lot of yellow indicators here. A quarter ago, we had 7 green indicators. We're down to 5. 4 of the ones that were green have moved to yellow for good reason. I'll talk through that in just a moment. 1 has gone from yellow to green. And so our net effect is we've got 5 green indicators and, of course, still 1 red one, which I'll come back to. But the 4 that went from green to yellow deserve a little bit of commentary, and that is interest rates, fiscal policy, energy costs, inflation. And 3 of those are directly tied to one another because of what's happened with the price of oil over the last 4 weeks. And as oil prices have spiked, energy costs have spiked. So that went from green to yellow. As energy costs have spiked, inflation has risen. So that went from green to yellow. And as inflation has risen, interest rate stability, I'll say, has some risk. And so that's gone from green to yellow. So we have kind of this, these 3 areas very interwoven right now, kind of a domino effect of energy leading to inflation, leading to interest rates, because the sense coming into the year, and I'll spend more time on this later, was that interest rates would decline a couple of times this year, that we'd probably have 2 quarter-point cuts, so a half point throughout the year. And that looks less and less likely as inflation has risen as a result of energy costs. So all that said, this isn't necessarily bad news. There's not a lot of red dials here. Our forward-looking forecasts are not negative at this point. They're just very neutral. We don't see a ton of positivity. I will note 1 green here, the corporate profit growth has been very green. Like we've seen very strong earnings data come out of the earnings reports earlier this year. And we expect that to continue through the balance of the year. So we are still expecting a very, very good year. Probably not as good as the last couple of years in the market, but we are expecting a good year. And so we do think equity market valuation will stay in the red. In other words, stock prices will remain high. I would even say expensive. And although we had a little dip here at the end of March, as we work through the balance of the year, we think the market will recover, as it primarily already has. and um, and equity prices will stay high. But not a lot of negativity here, really. We've got 5 green dials. A year ago we had like 2, so we were better than we were 12 months ago. A lot of yellow, and again, a lot of this just tied right now to what's happening in with the price of oil and what's happening in the Middle East. So, and I'll spend some more time talking about oil a little bit later. So let's just take a look at the last quarter. Market was down. This won't surprise anybody, I don't think. Our first quarter data, S&P was down almost 4.5. Dow was down about 3. Mid cap and small cap were up though. International was down just a little bit. Bonds were essentially flat, and almost all of that happened in the month of March. So as we look at our quarter end data, it was, I'd say the broader market was down. Having said that, most portfolios weren't down a whole lot. While the S&P was down 4.5, because of a more broadly based diversified portfolio. I'm going to spend a lot of time on diversification later, but because of a broadly diversified portfolio, most of the portfolios that we manage, we were seeing, essentially, depending on how conservative, how aggressive you are, kind of a flat to maybe down 2% through the first quarter. And that's because, there were areas of the market, mid cap and small cap in particular, that were up, so, and so those kind of carried the portfolio. And again, bonds were essentially flat. So depending on how conservative, how aggressive you are, we did see, some returns that were, relatively flat to maybe down a point or two. One note here, because I can't help myself, is to look at our 1-year data. So as we broaden out, I know this is about the last quarter, but as we kind of zoom out and look at the 1-year data, if you remember, if you're with me a year ago we were talking right now at like the 3rd week of April about what was happening in Q2. So while it was a Q1 review, you'll remember I kind of started off saying, I know this is about Q1, but I'm going to actually start this talking about Q2, because what had happened was the tariff plan had just been rolled out. And so the market had retracted about 20% over 3 weeks. And if I had said then, don't worry about it, a year from now, the market will be up, almost 18%. Portfolios will be up, 10 to 15%. I'm not sure anyone would have believed me in the midst of that. But here we are. And a year later, the market is up almost 18%. Portfolios are up 10 to 15%, depending on your risk level. And, certainly our 3-year data looks just as good. So, and we do, again, think this will be another positive year. How positive remains to be seen. We did set an all-time high yesterday on the S&P 500, so we've seen a good rebound here since the end of March. As we came into this year, if you were with me last quarter, we talked a lot about thinking the S&P probably finishes between 72 and 7,400. I will tell you, though, there's still a couple of economists that we follow that are calling for the S&P to finish around 6,000 to 6,200, which would be like a 10% decline on the year. We don't see that. I understand where that logic is coming from. I really do. But there's enough momentum. There's still very good earnings data that we think that we're still in for I'd say a mediocre year, probably, an 8 to 10% return on the S&P this year. Nothing like we've seen over the last couple of years. I'd love to be wrong about that. I'd love to see it up, another 15 or 20%, but we just don't think that's realistic given where earnings data is. As good as it is, stocks are still so very expensive. We just don't think there's that much room to run right now. And so we think we're in for a good year, just not a great year. But as we look back, we have certainly had a very good year over year, despite the fact that first quarter was, kind of went out with a whimper. as they say. So let's talk about stocks a little bit. Equity markets are still a bit expensive. Now, at the end of March, really for the first time since last year, stocks were, I would say, reasonably priced, right? The PE ratios were around 19. If you've been with me before, anytime the PE ratio gets over 20 times, stocks are expensive. So we got below that mark, but nowhere near the long-term averages. And again, just real quick, PE is price to earnings ratio. So think of it this way: if a company has earnings, so interest income, dividends, whatever it might be, but the earnings of the company, let's say that it breaks down to $2 per share, per outstanding share of stock, and that stock is trading at $10. That's a 5 times PE, right? Long term, the S&P 500 index, so all 500 stocks on average, have a PE around 17. Anytime it gets over 20, we say the market is frothy and stocks are expensive. And that's really where we've lived for the last 2.5 years. But at the end of March, for a brief moment there, stocks were back in a normal range, which is good for those of us who are contributing to 401ks and IRAs and rebalancing our portfolios. There at the end of the quarter, we're buying back into stocks that were more reasonably priced. Today, my guess, I won't have this data till the end of the month, but if I had to guess, ongoing PE is probably now going to shoot up to around 21 again. But as we hit the end of the quarter, we are in a more affordable range. Now, even if it goes up, that doesn't mean we stop buying stocks. It doesn't mean we stop investing. It just means we're not getting as good a relative value in the short term as we were a few weeks ago or even a few years ago. Stocks are nowhere near cheap. The truth is, we love it when stocks are cheap, but we don't usually love what's going on at the time. When stocks are cheap, it usually means the market's down 15, 20, 30%, and earnings are still decent. And those are wonderful times to be buying stocks. But it doesn't feel like it in the middle of it. So stocks are still expensive, and that's why we see that one red dial that we saw a couple of slides ago. But keep investing. We still think there's some room to grow. But like I said earlier, just more tepid short-term expectations. One benefit, I suppose, of the market being down in March, and one of the big reasons the market was down at the end of March, was that the top 10 companies in the S&P had dropped in value. So again, a quarter ago, the top 10 companies were making up about 42% of the market cap of the S&P 500. So again, to put that in perspective, that means the other 490 companies were only making up 58% of the weight of the S&P. So as those 10 companies move, so too moves the S&P. And that's really what we saw at the end of the quarter. The top 7, which are all tech stocks, NVIDIA, Meta, Tesla, Amazon, Alphabet, Microsoft, Apple, those top 7 stocks were actually all down for the quarter. So, and down pretty significantly, down on average. I know this is a hard slide to read, but down in the aggregate 11%. So what does that mean? It means the rest of the S&P, the S&P 493, if you will, was really only down 1%. It was kind of flat for the quarter. So again, broadly, U.S. stocks were doing very well. Again, mid cap, small cap were up. And so as you widen out and look at like the Russell 3000 index, it was relatively flat for the quarter. The U.S. stock market was pretty flat, but the S&P got dragged down by these huge tech companies, in large part because investment in AI slowed down in the first quarter, and so investors kind of peeled back their positions in these big tech companies, and we saw a little bit of a sell-off. I wouldn't call this a mass sell-off by any stretch, but we saw a little bit of a sell-off in these big tech companies in the first quarter as the investment in AI kind of slowed down for the quarter. And you can kind of see that here, as compared to 23, 24, 25, AI related industries really slowed down here in Q1. Now, that doesn't mean investment has stopped. We're still going to see data centers popping up like tulips. They're not going anywhere. The investment in AI isn't stopping, but it did slow down a little bit. And so we saw some, dialing back of investor holdings in those big tech companies. Volatility is normal. I can't help myself. I got to include this slide. And already this year we've seen it, right? We hit a -9 at one point in March. Got 2/3 of the way through March. The market was down about 9% year to date. And yet that's normal, right? Every year we have to sit through negativity, right? The market's going to fall at some point throughout the year. Again, the only way we get all the positives is to sit through all the negatives. There is no better way that we've ever figured out to capture all the positives, but to sit through the negatives. And the negatives are almost always temporary. I mean, keep in mind, every single year, on average, the market's going to go down about 14%. Some years that's 5, some years that's 25, but on average, it's going to go down 14%. And we just have to almost accept that as part of our investing experience. I will note, we don't think we're totally out of the woods yet this year. It's still a midterm election year. We still have volatility around, oil and, conflict in the Middle East and all the emotion that goes along with that. And so I think there's still a little bit more of a roller coaster to ride. We would not be surprised to see the market, pull back another 12 to 15% even at some point this year. Again, that we're not expecting a bad year, but these interim changes happen. And to see something like this kind of late summer, early fall, as we get closer to the election, would not surprise us in the least. Again, it's something we'd love to be wrong about, but we just don't think we're out of the woods quite yet. And despite the fact that, market is now up, a couple points for the year, as we sit here today, we do still think there's room for some additional volatility as we work through the year. But that's normal. It's just a part of it. We've certainly come to expect it. But on the plus side, it's how we get those good returns. I threw this in just on that note. We were getting a lot of questions as a firm, a month or so ago about how the market might react to conflict, how it might react to, what's happening in Iran. And the reality is investors really tend not to care much about conflict. And I don't mean that certainly, I don't mean to be dismissive in any way of the real human impact of conflict, missiles flying around and bombs and loved ones who are serving overseas, or even family. In no way am I dismissing the real impact of that in a human way, but investors don't really care. The market tends not to react negatively to conflict, and we're seeing that here. A year later, a year into the conflict, you can see in every one of these that we selected, the market was up a year later, except for 2022, and that had nothing to do with Russia or Ukraine. That had everything to do with what was going on with inflation at the time. But in all other cases, the market was actually up a year later. And even in the short term, a week, a month, it's kind of a mixed bag, right? Some negatives, some positives. Usually it has something else to do with what's going on in the world, not a lot to do, or something else that's going on in the economy, not necessarily what's going on in the world. And so it's just the reality of it. The market doesn't care. Investors don't care. They recognize that businesses which is at the end of the day what we're investing in, that businesses will adapt regardless of the situation. And really, the only cause for volatility over the last month hasn't been because there's conflict. It's really been because oil prices have spiked. Now, yes, the oil prices has spiked as a result of the conflict. I understand that, but it isn't the war itself that's sorry, we can't call it a war. It isn't the conflict itself that is causing market volatility. It's the fact that oil prices have gone from $55 a barrel to $105 a barrel, and the concern about what that could mean for shipping costs, for manufacturing costs, on top of additional tariff costs, and those kind of trickle down impacts have had far more impact on investors' perspective than the war itself. So the conflict itself. All right, so let's talk about the economy. If it wasn't for oil, this actually would be the headline for this quarter. And that is, again, kind of as I started, a bit of a weakening economy, at least through, the fourth quarter, which is, the data that we have right now. Q4 GDP came in at 0.7%. If you were with me a quarter ago, we were talking about how hard it was to read the tea leaves on GDP. Usually we have a pretty good sense of where GDP is going to come in from a prior quarter. We won't have Q1 data for another month, but usually we can kind of tell based on the data we do have where we think GDP was going to come in. Last quarter, you'll know, we were really struggling with this because some of the hangover effect from Q1 and the net exports, all this purple here, was really making it difficult, and we weren't sure where that was going to fall in Q4. Net exports were essentially flat, so that it had almost no impact, as it traditionally doesn't. You can see net exports on average don't add much or take much away from GDP. But the real impact here came from government spending. Government spending actually was a negative to GDP in the fourth quarter. Again, typically it's a flat number, but it was negative. And that was a bit of a surprise. We thought last quarter was going to come in around 1.5. I did say it could be anywhere from 1 to 3, and we wouldn't be surprised. But it even ended up coming in under 1. And a lot of that was just we did not expect to see government spending as a negative number in GDP. If it was even just flat, this 0.7 would have been 1.7, but it wasn't. So there we find it. Now, it isn't negative. We're not headed towards recession. We don't see any reason why Q1 will be negative GDP. So we do not see recession around the corner. If we had to put a number on it, we're probably 1.2%. But long-term averages are 2. So anytime we're under 2%, it usually is a sign that the market or that the economy is tightening a bit. And you can kind of see where we were in 3, 4, and 5. 23, 24, and 25. First quarter last year was an anomaly because of what was going on with tariffs. But we do see some tightening of the economy, some weakening of the economy. That does not mean it's weak. It doesn't mean we're in free fall. It doesn't mean we're headed towards recession. That just means that the economy, again, is weakening. And it could strengthen tomorrow. We don't see signs of recession, and I think that's probably the takeaway there. But there is some data that we don't love. I mean, again, I started off saying, kind of a mixed bag, and here's another one of those things. And that's our unemployment data. Long-term unemployment averages are 5.5. Today we're at 4.4. But directionally, we don't love this. So the current data isn't bad. It's still well below long-term averages. Unemployment is still low. If we weren't looking at the direction of this and just looking at the data point, it looks pretty good. Very low unemployment, 4.4%. But directionally, we just don't like it. It's been going up very steadily every quarter for the last 3 years, and we don't kind of love that direction. So Again, signs of weakening, but not signs of weakness. Labor demand is no different. Job openings are down, hires are down, layoffs are up. Again, all heading in a direction that we aren't super excited about. But as a data point, looking at long-term averages and that kind of stuff, the current data isn't bad. It's just directionally not good. And so it shows signs of a weakening economy. Hopefully that turns around and we see, I'd love for any of these data points to turn around, like layoffs just to dip a little bit, or hires to jump a little bit, or labor demand or job openings to jump a little bit. Like just give me one good quarter where we can kind of feel good about this. We just haven't had that over the last couple of years. It tells you kind of how strong we were maybe 2 and 3 years ago from an economic standpoint. That even as things have been weakening over the last couple of years, the data points are still positive. Like it's still a strong economy, just signs of weakening. Here's one area that isn't showing much in the way of weakening, and that is delinquencies. So our 30-day late pays haven't really moved a lot. Now, student loans, I'll talk about in a second, but auto loans, credit cards, mortgages, all holding very steady over the last 2 years. Mortgages are holding under 4% in delinquencies. Auto loans, credit cards have been stuck right around 8%. And long term, those are all very, very, very normal numbers. So really match very well with long-term averages, not at all a concern. If mortgage defaults get north of 5%, that's where we get nervous. If auto loans and credit cards get north of 10%, that's where we get nervous. But at 8 and 4, that's pretty typical, not a big issue. Student loans, different story. Can't kind of believe it's at 16%. Really hope it doesn't get to 20%, but it's a smaller portion of the population. And so it's not something that we're terribly concerned about. Because a lot of times what this data leads us towards is unemployment issues, that the unemployment data we're seeing, which is always lagging, even as this is, but this is sometimes a leading indicator showing us that there's more unemployment because people are having a harder, or underemployment, right? Because people are having a hard time paying their bills. That's not what we're seeing here. Now with student loans, that younger population in the workforce who has student loans, that's a different story. And in large part, we think that's because for, the better part of 3.5 years, student loans were in deferral. There was no payment due, particularly on federal loans. And there was also a belief that many of those loans would be forgiven. And so we just think that population went out and kind of started their careers and, built a budget and did not take into account that someday they would have to start paying those student loans again. And whether that's good or bad, I'll set that aside for a moment, or whether they should have or shouldn't have. But that's where we think we are. And so we're seeing a huge spike, obviously, in student loan delinquencies. We hope that starts to taper off or at least flatten out. It'd be, tough to see, 1 in 5 student loans in delinquency. But again, it's a smaller segment of the population. So as a indicator of economic strength, we're not terribly concerned about it. But the auto loans, credit cards, mortgages, all very good data, So again, not a sign of weakness here at all. Inflation. All right. Again, I'm going to talk a lot about inflation in about 5 minutes or so, but I'd love to pretend that I don't know what I know here. And that is, I'd love to pretend I don't know what the March number was. Because January and February looked great. Inflation through January and February year over year was 2.4%, getting really close to that Federal Reserve target of 2%. And that's why coming into the year, we really thought the Fed would lower interest rates at least a quarter point 2 times throughout the year. And they were sort of leaning that way. They never really tell you what they're going to do throughout the year, but the indication was such that the Fed we really thought the Fed would lower rates 0.5 point this year. No more. And why? Because in March, this data that came out last week, inflation was 3.3% year over year. So it jumped almost a full percent from February to March, all tied to energy. With oil prices, right? Because everything else is looking so good. Shelter had declined. That's kind of the dark blue there. Auto insurance prices had been, I got to be careful. Prices weren't declining. Inflation was declining, meaning when inflation goes down, prices don't go down. It just means they're not going up as fast, right? So it's not as though housing prices were down, but housing inflation was down. So housing prices were slowing. They weren't going up as fast. Auto insurance was slowing. It wasn't going up as fast. Really, the only things that were up in any meaningful way was like food at home, so kind of groceries, but everything else had been declining. So inflation was really in a very, very good place coming out of last October through February. Like we were very excited about this and really thought that the Fed would cut interest rates. We thought that's going to be very good for the market. It's one of the reasons why we thought the market would be up this year. But at least one of these we think has gone away. We still believe that there's a good chance that the Fed will lower interest rates because we do believe that as we get through the year, the issues with oil will resolve. Price per barrel will come back down. And thereby that inflation issue will dissipate. Because what we're not seeing here is what I'll call real inflation. And what I mean by real inflation is we're not seeing a huge run up in M2 money supply. So it's not like we're pushing cash into the economy or printing dollars. And obviously that's real inflation. When there's more money in the economy, the money we already had becomes worth less, not worthless, but worth less. And so prices rise. This is really more of a supply and demand issue, what I'll call kind of price inflation, not monetary inflation. And so, so this has a chance to resolve. We don't use the word transitory anymore, but this does have a chance to resolve. That energy prices can come back down pretty rapidly, and we can get inflation back into that 2.5% range pretty quickly. And if that happens, we still think the Fed will lower interest rates at least one time throughout the year because of the otherwise, I'll say, weakening economic data. We do think there's an opportunity still for that to happen, although the market is not pricing that in, and you'll see that in a minute. And one of the reasons why we want to see interest rates come down, or I don't know that we want, one of the benefits to seeing interest rates come down is that it reduces the net interest we pay as a country on our existing debt. So one of the things you'll note here, again, if you're with me a year ago, our deficit spending a year ago was just a couple bucks shy of $2 trillion. As we go into 2026 budget, the deficit is about 1.8 trillion. So we are spending less and raising more, right? So tariffs have had some impact because the total spending hasn't moved a whole lot. It was about 7.5 trillion a year ago. So spending hasn't changed much, but our federal revenue is up as a result of higher tariffs. But if interest rates go down, one of the big benefits of that is the interest we pay goes down. And if the interest we pay goes down, our deficit spending goes down. And if our deficit spending goes down, we can issue less debt this year to pay for last year's debt, right? And that's all positive. So it's another one of the reasons why we'd like to see interest rates come down, on top of, again, the broader economic impact and the frankly justification for higher market prices. But oil is expensive, and I wanted to throw this one in here just for some historical context, right? A quarter ago we were at $55 a barrel. Now we're at $100 a barrel. But it's not as though the market or the economy, I shouldn't say the market, the economy can't manage $100 oil. Like $100 a barrel oil is essentially where we were from 2010 to 2015. And both the markets and the economy were doing just fine at that time. In fact, we were coming out of the Great Recession, and the economy was relatively strong. we can absorb as an economy higher oil prices. It's not preferable on a whole bunch of levels. We don't like it at the pump. If consumers have to pay more money at the pump, they have less money to consume other things. And one of the big reasons GDP looked so good was consumption, right? Consumers are out buying things. And when they're out buying things, that drives GDP. So if what they're buying is less because oil prices are higher, that's not a good thing. Again, I go back to commercial use and shipping and manufacturing. We don't like higher oil prices, but it isn't like certain economic collapse because of higher oil prices. No matter I don't know what the political posturing might say, we can, as an economy, absorb higher oil prices. Now, one of the questions that came in ahead of this, and I'm going to spend time on this on the next slide, but on some level, if we if we didn't care about anyone else in the world, and we if oil prices were not set globally, none of this would much matter. In 2025, the U.S. produced 23.6 million barrels a day and used 20.6 million barrels a day. So, when we talk about like energy independence, theoretically, if we didn't ship any of our oil anywhere and kept it all domestically, which is not realistic, by the way, but if we did, we could set our own prices on oil. Right? Or at least nationally, we could set our own prices on oil, but that isn't really how it works. Oil is global, so we ship our oil out. Oil prices are set globally. And because other countries are dependent on our oil, we are not terribly dependent on other countries' oil, as we were just seeing, although in some ways we are. But if there's a disruption anywhere, which is what we're seeing in the Middle East right now, it's a disruption everywhere. So prices do go up no matter what. And, and there's other reasons for that. We export different types of oil. We need different types of oil that we don't produce here. We don't have as much refining capacity as we once had. So there, it is for better, for worse, oil is a global issue, and the price is thereby set globally. So we don't get to just set it domestically. Consumer confidence in the stock market. This is not at all a surprise. Market was down in the first quarter, so consumer confidence was down. I'd still note that it's pretty low. It's not, the market was at one point in the first quarter had hit a couple of days of all-time highs. But I'm not at all surprised to see it down. I was surprised to see it down in the fourth quarter, coming out of a fantastic 2025 as far as the market's concerned. For consumer confidence to be as low as it was then was a bit of a surprise. But not at all surprised here. Again, nothing we really do with this other than to keep an eye on it, but just kind of gives you an overall sense of the sentiment right now. But the market has really rebounded very nicely, and we'll see if it can hang on to it. All right, fixed income. I talked about this a minute ago. Interest rates. We came into the year, the federal funds rate was about 3.6. You can see though that the market through 2026 is not expecting any interest rate changes. The market expectation is at 3.6. We came into the year at 3.6. So there's no expectation that the Fed's going to lower interest rates this year, which is unusual. Typically, over the last couple of years, at least, the market expectations have been much higher than even Fed projections. But, Fed projection coming into the year was 3.1. We aren't going to get down to 3.1. We don't think that would have been that half-point move. But we do think we can still see a quarter-point move throughout the year this year, depending on what happens with energy prices. So kind of cross our fingers and hope for that. But the yield curve is very normal. So this is important for a couple of reasons. One, it's just nice to see. This is the way it should look. And that is that long-term interest rates are much higher than short-term interest rates, right? Which makes sense. If you're going to tie your money up for 30 years, you should get more interest than if you're tying your money up for just 1 year. So that makes sense. And that is a normal yield curve. The benefit of a normal yield curve from a planning perspective is that we can note that the bond market or bond investors are not expecting recession, because if they were, this would invert. And that's kind of where we were in 2022, 2023, when the market really did believe we were headed towards recession. And so we saw the bond market revert. But and that happens because there becomes an expectation, if we think we're headed towards recession, there becomes an expectation that short-term rates are going to have to go down, that the Fed will have to lower short-term rates to try to kick the economy back into gear. And so if short-term rates are going to drop, then what happens is the long-term rates start to drop, because that is set more by investor expectation. And so you get this, for a time, you get this inverted yield curve where interest rates on the short end haven't changed yet, but interest rates on the long end have, based on expectation. And so it's a sign that investors believe we're headed towards recession. There's no sign for that at all right now. This is a very, very healthy, normal yield curve. And one more reason why we don't think we're headed towards recession, on top of all the other good economic data that's out there. All right, so let's talk for the last 10 minutes here about inflation. And I want to spend time here really based on a couple of client conversations that we've had over the last couple of weeks. But this is one of those drawings that I put up. I wish I could take credit for it, but I've stolen it. But there are things that matter. There are things you can control. Where our focus should be is the intersection of those two things. And really, at the end of the day, what we can control the most is the way that we react to what's going on. I mean, there's a lot of things out there that matter to us that we just have no control over. And I suppose there's a lot of things that we can control that really don't matter. But again, where our focus should be is, in large part, how do we react to the things that are important to us as change happens. And again, this has a lot to do with what's happening right now with oil and conflict. But I wanted to talk about inflation because it is, when we talk about risk as a whole, inflation has a tendency to get left out. We talk a lot about market volatility and market variability and bond prices relative to interest rates. And we talk about all these potential risks. But we have a tendency to avoid what I think is probably the largest risk for anyone in or heading into retirement. And that is inflation, because it's quiet. It's silent. It's kind of the thief in the night. And you don't notice it until you look back most times. And yet it is very, very real and can be exceptionally disruptive to a very good long-term retirement plan. So what I picked here was a 30-year time horizon. So I went back to 1995, and I did that intentionally because the average life expectancy for a married couple retiring in 1995 was 30 years. And that number hasn't changed very much. It might be 32 years now, but if you're a married couple retiring around 65 today, the odds are better than 50% that one of the two of you will be living beyond 95. So this is well within that framework, right? And so I went back to 1995 and I just grabbed some numbers for illustrative points. And what you'll notice is, over a 30-year retirement at an average of 3% inflation, which is the long-term historical average, if you track it all the way back to 1926, that's a 2.5 point increase, or 2.5 times increase. Not point, but 2.5 times increase on cost. So a stamp in 1995 was 32 cents. Today it's 78 cents. The truth is, I didn't even know it was 78 cents because all my stamps say forever on them. So I actually had to look this one up. And it looks like stamp prices might be going up to 82 cents this year. A Hershey bar went from 50 cents to $1.25, a loaf of bread to $3, a gallon of gas in 2025 at least was $3. I know it's more like $4 today. Big Mac, I don't eat a lot of Big Macs. I don't know that I'd pay $5.50 for one, but that's where we were. And the one that really caught my eye, and maybe it's especially for those who know me, I'm kind of a serial auto purchaser. So that's probably why this one caught my eye. But the average price of a new car in the United States in 1995 was $18,000. The average price of a new car in the United States in 2025 was $48,000. And yes, that is still a 2.5 times increase, but that just really stood out to me. It just did. That is the impact of inflation. It is the silent erosion of purchasing power. The dollar that you had in 95 has been cut by over half, and so we need 2.5 more dollars for every dollar we spent. And that is a real issue through retirement. And I bring this up because we had a client who asked a really clever question a couple of weeks ago. And the question sounded something like this. The current rule of thumb on withdrawing money from my portfolio is 4%. And that's true. We've been using 4% for the better part of the last 22, 23 years. So the rule of thumb on portfolio withdrawal rates in retirement is 4%. It's broadly considered to be the safe withdrawal rate. So if that's my safe withdrawal rate, and right now I can go out and buy a 30-year U.S. Treasury paying 4%, why in the world would I put myself through the volatility and the pain and the heartache and the sleepless nights to get the same 4%? Like it doesn't make any sense. And on its face, that is a very compelling question, right? Like I can get 4% or I can get 4%. One is fixed and safe and backed by the U.S. government. The other is volatile and all over the place, and who knows what it's going to be worth day to day. Wouldn't I rather have the safe one? It's the same 4%. However, it isn't the same 4%. It doesn't work. And I want to talk you through why it doesn't work. And at the end of the conversation, the client understood. But I'm using $1 million here. It could be 100,000. It could be 500,000. It could be $100 million. It doesn't make a difference. It's the same 4%. So if I had a 4% bond for 30 years of retirement, if that's my retirement timeline, in year one, I get $40,000. Easy math. The problem is everything I buy costs more every year. And so that $40,000 at the end of year one, when I go to take out my next year's income, now needs to be $41,200 at an average long-term inflation rate. So now I get my $40,000 of interest, but I have to pull an additional $1,200 of principal. Now that doesn't sound like that much. I mean, out of $1 million, now I'm down to $999,000. Like not the end of the world. But this keeps happening. So in year two, now I've got to pull out 42.8, if I'm remembering my math correctly. So now I've got to take out $2,800. So now I've got something like $997,000. And the 4% is now off of that lower principal number. And so what's happening is like compounding in reverse, right? And if I just live long enough, I will very slowly and very safely go broke, right? So it doesn't work. It just doesn't work. And the reason it doesn't work is that what's really happening here is you're getting 4%, but inflation is 3%. So your real return is just 1%, which on $1 million would be $10,000, but you're not taking out $10,000. You need $40,000 to live on. And so you're stripping out your principal, albeit slowly, albeit safely. You're stripping out your principal over time. And eventually, if you just live long enough, 25 to 29 years in this case, you will end up with zero. You'll go broke. So we don't need 4%. What we really need is like 7%, because 7% minus the 3% gets us the 4% income that we need. And the only way we get 7% consistently over time, the only asset class that has provided that consistently over time has been equities. And that's why at least a portion of our portfolio has to be in equities. Now, what's interesting, I suppose, at least to me, is then there's the counter argument. If I go all the way to the opposite extreme, well, okay, this didn't work, and I need 7%. So then why don't I just put all of my money in the S&P 500? And by the way, that doesn't work either. Although if I had to pick one or the other, this one I would say gives you a better opportunity for it to work. Now it's difficult because of the volatility. And when you're pulling money out at low points, that can really hurt you. And I'll show you that in a minute. But this gives you a much better opportunity to win if we look at it that way. So I did the same thing. I went back to 1995. We put $1 million in, and I wanted to go through a couple things. And by the way, if you read our quarterly newsletter, whenever that was out 3 weeks ago, my opening letter, or my opening to that newsletter, was on this topic. So if it sounds familiar, I'm just kind of broadening that conversation. But in 1995, the S&P 500 on average that year was about 550 points. And no, that's not a typo, 550. In 2025, it averaged about 6,500. So that's real growth right there. We'll call it about 12 times growth. But the more important part for this conversation is that the dividend per share in 1995 was $14. And in 2025, it was $78. That's 5.5 times growth on the income against 2.5 times growth in the expense. Right? So inflation took our expenses up 2.5 times, but the income from the S&P 500 was up 5.5 times. So if we were only living on the income from the S&P 500, we would have stayed ahead of it, right? And here's the math. I took that same $1 million. We bought 1,800 shares at $5.50 a share, and that generated then, at $14 per share, $25,000 in income that year. In 2025, that's the equivalent of $140,000. That's what it would have been at $78 per share. And your $1 million grew to something like, 10 to 12 million, depending on how much you had to take out, because of the appreciation from 550 to 6,500. But what you're probably catching is, well, Pete, like 25,000 isn't the number. We're taking out 40,000 in the other portfolio. That is very true. And it is actually why, at the end of the day, the S&P 500 as your only investment doesn't work a whole lot better than a 30-year bond as your only investment. Because you do have to withdraw another $15,000 of principal every year to meet your 40,000. That doesn't mean you run out of money, but again, because of volatility, the timing on this could be really problematic. And I'm going to show you that in a minute. But that is why then we diversify. And so I want to walk through, I showed these slides a couple of years ago. So these are a couple of years old, but the point is still a fair one. So if we just take an average 60-40, 60% equities, 40% fixed income portfolio, large cap, growth and value, mid cap, internationals, some bonds, some cash. So a very moderate, middle of the road, average portfolio, and track that over time. you're going to see that the reason why we diversify rather than putting all of our money in bonds or all of our money in stocks, broad diversification works. And at first glance, it doesn't look like it works, to be perfectly honest. In the portfolio, our $1 million, and this goes back to, by the way, 1999 to 2024 was the 25 years I was tracking when I did this exercise a couple years ago. So our starting balance was still $1 million. After 25 years in our portfolio, we had about $5.6 million. And after 25 years in our S&P 500 index fund, we had $5.7 million. And so you look at that and go, okay, well, why diversify? Like I here I had $100,000 more than in my portfolio. If I just kind of put it in there and stared out the window for 25 years, I'd have had more. Yes, kind of. Stick with me. And on top of it, by the way, our Ally McGraw and love story, love means never having to say you're sorry. On top of, the S&P having more money, diversification never feels good. So while love means never having to say you're sorry, diversification means always having to say you're sorry. Because diversification never feels good. Right? Because on the ups, when the market's doing really, really well, your diversified portfolio isn't going to do as well. And I'll pick on anyone. 2019, the market's up 31%. Your portfolio is up 19%. And don't get me wrong, like up 19 feels really good, but not as good as 31. I'd rather be up 31%. So I appreciate all the diversification and whatever, but I'd rather be up 31. I'm only up 19. And, on the flip side, let me pick one here. Large cap was down 18%. Your portfolio is still down. Now, it's not down as much, so that makes you feel a little bit better, but it's still down. Market's down 18. I'm still down 14%. That doesn't feel great. Like, it never feels good to diversify. It's so boring. It never really feels good because you don't keep up on the upside. And yes, you don't keep up on the downside, but you're still down. And so it never really feels great. So why in the world would we as professionals, your financial planners, put you through this? Like, if it's not going to feel good and you're going to end up with more money, why in the world do we tell you to diversify it all the time? Well, part of it has to do with your tolerance for risk and your ability to weather storms and stay in the portfolio. And there's a lot of investor like emotion that we're trying to and psychology that we're trying to manage through diversification. But a big part of why we diversify actually comes down to real world experience. And so this is what's happening in between, right? So if I invested $1 million in 1999 in portfolio one, it grew to be 5.6. In the S&P, it grew to be 5.7. And this is what happened everywhere in between. But this is what happened when you retired. And so I'm going back to needing that $40,000. So I'm going to pull out 4% per year, but that is going to inflate. And this is the real key here, everybody. It's not 4% every year. It's not $40,000 forever. 25 years in, you're taking out $71,000. And that $71,000 is buying you the same amount of goods that $40,000 bought you in 1999. No sleight of hand. Here's the inflation numbers. I didn't even use it like average inflation. I actually used real world inflation here, going back over that 25-year period. It's not buying you one more candy bar, one more loaf of bread, one more gallon of gas. You're getting the same amount of stuff for $71,000 that you got for $40,000. The portfolio, however, grew over that time frame. Grew from $1 million to $1.8 million, nearly double over that 25-year time frame. Your S&P was cut by 3/4. You're down to $225,000. That $71,000 withdrawal rate, in a couple of years, you're going to be broke. And that is why we diversify. That's it. So why did that happen? Well, in the S&P, we had more volatility. We had larger downturns, and we still needed our income. So when the market was down in 2000, 2001, 2002, in 2008 and 9, in 2018 and 2022, those downturns were more drastic because of the lack of diversity or diversification. 2000, the market, the portfolio was actually up, and you weren't down anywhere near as badly in 01 and 02. You weren't down anywhere near as badly in 08. You weren't down nearly as badly in 2022. 2018 was about the same. And because it wasn't down as much, the impact of the withdrawals didn't strip out as much cash. And so your portfolio was healthier. And that is why we diversify. Can't make a killing, can't get killed. That is the joy of diversification. And it's why we do it. Because we have to keep up with inflation. Because if we don't, it will silently kill your retirement. So with that, I appreciate the time, everybody. Thank you for spending, the better part of an hour here with me today. I hope it was helpful. I hope it was worth the time. If you think I missed the mark in any way, I always welcome that feedback. So please send me an email. But if you have any questions, any concerns, please reach out to us. We'd love to help. If there's anyone in your life, friends, family that we can help, please send them our way. We'd love to help any way that we can. But otherwise, get out inside, enjoy the spring weather, and we'll see you again next quarter. And again, thanks everybody for spending the time. Have a great day.